Tonight, we're really pleased to talk with Ben Felix. I think many of you who've signed up and who registered for this have already spent tons of hours watching or listening to him talk. He's best known for his YouTube channel, where he publishes pretty amazing videos on the topic of investing in personal finance. Together with his colleague, Cameron Passmore, they host also a really good weekly podcast called The Rational Reminder, where they really go deep on some of the topics and interview really interesting people from the world of finance. So before we start off, many of the attendees actually submitted notes of appreciation surrounding you, Ben, for your work. So it just shows how respected and well regarded you are. So we'll read a couple of them. The first one was from a Reddit user who's I Want to Fire in BE, who said, "I love the content this dude is doing. I must have watched all his videos. Him and the Plain Bagel, who's also Canadian, are keeping it real in the personal finance space on YouTube." So just thanks to him for keeping it real. Second user on Reddit was Sarah Iveda, who said, "Ben is a great source of information, and above all, I really feel he's intellectually honest. So many people talking about personal finance are not." So the last comment really echoes how we feel about Ben. We respect his intellectual honesty and rigor so much, and that's why we asked him to kind of join us today. So let's get into some questions. However, if you want to ask a question for Ben, you can do so on the right tab under questions. However, we've had so many that we're not going to have loads of time, so we're only going to pick one that will ask Ben at the end of the live stream. So Joran, the floor is yours to ask Ben the first question.
Great. So hi everyone, I'm Joran. So the first question is about the rise of the individual investor. So we've seen within last year what we call the rise of the individual investor. So driven by low interest rates, people save more money during the pandemic. And it's also been more easier access to investing through apps. And so Ben, how do you see this trend evolve in the future?
Well, I think we have to remember that the rise of the individual investor, maybe there was a bit of an uptick last year, but it's been on a pretty significant downward trend for the last 80 years. In the 1940s, this is using US data, because that's where all the data tends to come from. But using US stock market data, most stocks were held by households in the 1940s. And today it's only about 33%. Maybe last year was about 33%, and the uptick maybe brought it up to 36% with all the influx of new investors last year. So I don't know if we're really seeing the rise of the individual investor. Maybe a small uptick. I think we also have to remember that last year was not the first time that we've seen a big influx of people getting into stock investing through self-directed accounts. The tech bubble in 2000, leading up to the late 90s, leading up to that, something similar happened where all of a sudden people could access trading on their own. Maybe it wasn't as slick and maybe it wasn't as low cost as it is today, but we saw something similar happen. And the end that time was a pretty significant decline in the types of stocks that people were trading. And I think that shook a lot of people out from being self-directed, or at least trading stocks in that way. So where do I see this going? I think it's going to depend on how it plays out in terms of stock prices for the types of stocks that all of these individual, or not all, but a lot of these new individual investors seem to be trading in a relatively small handful of stocks. If those stocks do well, maybe we'll see more people getting into trading. If they don't do well, then I think we could have a similar situation to 2000, where a lot of people get scared off of that type of investing.
So this is primarily around index investing. Obviously, you're a strong proponent of a passive approach. If you had a single argument to convince someone about why passive investing is a better approach for most than active investing, what would that argument be?
I'll give you my argument. It's not one single argument. There are a couple in there that I think are really important. Index investing is low cost, first and foremost. It's the lowest cost way to access the stock market, and costs, as I'll talk about in a second, are one of the most important determinants of investor outcomes. And you can see this in the mutual fund landscape. Morningstar does a study where they try and figure out what is the best determinant of fund performance. And very consistently, the lowest fee funds have the best after fee performance, which maybe shouldn't be surprising, but it is surprising because active funds all say that they're going to beat the market. I think people are getting more familiar with the idea that they don't. So maybe it's not so surprising for the people listening to hear that. So low cost is a big one. You've got to remember that the market's a zero-sum game. So this is the other piece. Every active investor is taking a bet that if they own a subset of the market, so with an index, maybe I'll back up. With an index fund, you own effectively the entire stock market, a cross-section of all the stocks that exist that are tradable anyway. With active investing, you're really, in broad terms, you're doing one of two things. You're choosing a subset of the stocks in the market to hold, and maybe you're timing when you want to hold them. So some combination of security selection and market timing. That's the alternative. We have to remember though that in the market, it's a zero-sum game. What that means is every time that there's a trade, somebody wins on the trade, somebody makes a profit, but for that person to make a profit, somebody else has to lose. So that zero-sum game makes it makes active investment also a zero-sum game. All of the active funds that win at the expense of other active funds that lose. Now, if we take all of the active funds together and compare their average performance to all of the index funds, their performance before fees is going to be the same, because on average, active funds own all the stocks in the market, just as index funds do. After fees and costs, though, because actively managed funds have higher fees, and active investing, whether it's through a fund or through stock selection, has higher costs due to transaction costs and taxes if it's in a taxable account. After fees, the performance is going to be worse. Now, this concept is called the arithmetic of active management. Bill Sharp, who's a Nobel laureate, he wrote about this in a 1991 paper that's become quite famous. That zero-sum game before fees, and after fees, you're more likely to lose as an active manager. Now, that's not even my favorite argument, though. My favorite argument in favor of index investing is the skewness in individual stock returns. What that means is a relatively small number of stocks perform really well, and most stocks actually don't perform that well, which is kind of interesting. There's a paper with a provocative title, Do Stocks Outperform Treasury Bills? And you hear that, and it's like, well, of course they do. But the interesting thing is that a lot of them don't. And if you don't own the ones that do really well, you're much more likely to underperform the market. So that skewness effect makes active investing, even not considering fees, makes active investing really hard. In that paper that I mentioned, they built a model where they took 20,000 bootstrap samples where they constructed 50 stock portfolios. So they're kind of using real stock data, and they're selecting 50 stock portfolios, and they're running 20,000 simulations following that process. And over 10-year periods, the 50 stock portfolios had a 53% chance of underperforming the market, that's pretty bad. And that's before fees are considered. Over longer horizons, that chance of underperforming gets even higher. It's like 60% at the 90-year horizon. So you take those two things together, the skewness in stock returns and fees, and I think index investing starts to look pretty compelling. I do think it's worth pointing out, though, that there are types of stocks in the market that appear to be riskier based on financial theory and empirical observation. Owning those subsets, and maybe this sounds, maybe I sound like I'm contradicting myself, but owning the subsets of stocks that are riskier in the market and acknowledging that you're taking more risk by doing that, I think that there can be an opportunity to expect higher returns than the market. I just think that the traditional approach of trying to pick stocks and time the market is almost certainly detrimental. Index funds are a very elegant solution to that. But I guess within the concept of index funds, you can own things like a value index, for example, where you're not owning the whole entire stock market, but you might still have a shot at a little bit of outperformance by owning riskier stocks.
Great. Great for the answer. So to dive a bit deeper into the factor investing, so that's something you explain very well. So I think you have a white paper that you published that kind of explains the different factors and kind of theoretical background of it. If anyone who's listening here hasn't read it, I really recommend it. But there's a big difference between like the theory and what can be achieved in practice with the funds that are available to us. So here in Europe specifically, actually only a handful of index funds that invest in those factors. And they don't even seem to capture those factors really well. So given these limitations, what advice do you have for a European wanting to build a factor portfolio?
Yeah, so it's tricky, and I'll say up front that I'm definitely not an expert in investing in Europe and what the specific investment products over there look like. I can tell you, though, that the situation is somewhat similar in Canada. The big difference, though, is that in Canada, it can be fairly tax efficient for us to own US listed ETFs, and that makes their market accessible to us. And obviously, they have a lot of products available. My understanding is that it's not the same for Europeans. And this is a real problem. When I wrote the first version of the white paper that you mentioned, Joran, I basically looked at a bunch of factor products that were available in Canada at that time and asked the question of, do these products deliver on the risk premiums that they're trying to capture based on the structure of the product and the fees, which tend to be higher for those more specialized products? And my conclusion was that there were no Canadian products at that time, and I don't think it's changed much at this point, but there were no Canadian products available at that time that offered higher expected returns after costs. So I kind of said, if you want to do factor investing, here are some US listed ETFs that you can use. Now in Europe, like I said, I'm not the expert here, but I do know within the Rational Reminder community, which is an online community that's free for anybody to join, that stemmed from my podcast. There's a massive thread in there with a lot of people talking. I never go in there because I'm not that interested in investing in Europe. But there's a massive thread on how to implement a factor portfolio using the UCITS structured funds. So it's possible. And I know one of our moderators on that forum, he's very into factor investing. He lives in the Netherlands, and he is implementing a portfolio that's targeting factor exposures. And he's a pretty smart guy. So I think he's probably figured out a way to do it somewhat well. And if anybody wants to join the Rational Reminder community and check out that thread, or you can ask Alex, the moderator that I just mentioned, and I'm sure he can help. But it is a challenge being not in the US, where they have just so much more scale. It is a challenge to turn these theoretical ideas into real products that people can use. It's getting better, though. Even in the US, their product landscape has gotten better in the last couple of years.
Yeah. So do you think it's just a matter of time before kind of the fund providers catch up with the demand, basically for more factor?
We'll see. I mean, in Europe, the Vanguard just closed some factor products, or announced that they're closing them. I don't know if they actually closed them yet. So the demand wasn't there for those products, and they ended up shutting down. So maybe if there's demand, then maybe products will show up. But those Vanguard factor funds closing down seems to be evidence that maybe there wasn't demand. And I think that in the grand scheme of investing ideas, this concept of factor investing it's become more mainstream, but it's still relatively niche. I mean, in Canada, close to 90% of fund assets are still in traditional actively managed products. The rest are in index funds, and then factor funds are going to be a tiny fraction of that. So I don't know. We'll see. One of the tricky things about factor investing, I mentioned that you expect higher returns for taking more risk, which is true. One of the challenges that individual investors have, though, is sticking with risky investment strategies. And if fund companies see assets leaving the strategies, like value investing, as an example, which is a form of factor investing, it's had a very difficult 10 years. And if a fund manager is managing a value fund and they see assets flowing out, that fund business may not be viable. And that's probably what happened with those Vanguard factor products. So I'd love to think that the landscape's going to get better, but I can't make that promise, though.
Great. And I just echoed to join the rational reminder community. There's some really good posts on there of people sharing tons of information specific for Europeans, so it's really worthwhile. So the next question is actually going to be closer to retirement. So this was a Reddit user, Madefire BE, who shared it. It said, most investing advice focuses on young people who want to grow their capital. He'd actually be interested to hear your view, Ben, on where he should put his money if you're over 50 years old. So at that age, he still wants to, get some growth, but he'd like more protection for a potential drawdown. So now the bonds and bond ETFs are no longer the safe haven they used to be. He'd love to know what his options are. So I don't know if you have any insight on that.
Well, I think to answer the question, I would love to know why bonds are no longer a safe haven, because I don't know if I agree with that. I think interest rates are low. Bond yields are low. Real bond yields for shorter maturity bonds might even be negative. Yeah, that's not ideal. I agree with that. I also think stock expected returns are lower now than they have been historically. So it's not like it's just bonds that are suffering. But we also have to remember what the role of bonds is in a portfolio. They're never designed to be return-seeking assets. Historically, bonds have delivered long government bonds have delivered about a 2% real return, inflation-adjusted return. We probably don't expect that right now. Now, I'm saying that bond expected returns have been really low for the last, I don't know, a while, 5 or 6 years. But meanwhile, bond realized returns have actually been very high over that period. So it's one of the tricky things with expected returns. I guess you might get something better or worse. In this case, bonds delivered better returns. But anyway, I'm digressing on that. So I don't think bonds are the role of bonds in portfolios has not changed. You don't own them to seek return. You own them to decrease volatility in your portfolio. Now, why would you want to decrease volatility in your portfolio? Maybe because you're worried about sequence of returns risk. That's as a retiree getting several bad years of returns in a row while making withdrawals. That can be detrimental. Bonds can help to reduce volatility from that perspective. Even in that case, though, in back tests, all stock portfolios tend to look pretty good, even for retirees. And I'm not suggesting that that's what people should do. But the real reason is from a psychological perspective, to reduce volatility in your portfolio, you own bonds. And I don't think that has changed. I just think we need to revise down our return expectations for both stocks and bonds. But that's more of a financial planning implication than a portfolio management implication. Like, I'm not going to say, because yields are effectively zero or close to zero, or maybe negative in real terms, that doesn't mean that you should own, something else. I don't know, gold, I hear, or crypto, or real estate. Those are all very different from bonds. They don't provide the same type of stability. One of the other concerns that I hear about bonds is maybe somewhat related to yields being low, but also quite a bit different, is inflation. If inflation picks up and gets really high, then bonds, they decrease in value. Bonds get hurt really badly. Nominal bonds, you can get bonds that are inflation protected, but nominal bonds get hurt really badly in an inflationary environment. But the opposite is true in a deflationary environment. And I know everyone's worried about, at least where I am, about inflation right now. Policymakers are more worried about deflation, which is why we're seeing all of the monetary and fiscal decisions that are being made. Now, are we going to get inflation or deflation? I don't know. If we get deflation, bond returns historically have been phenomenally good, like better than stock returns in a deflationary environment. So I don't know if I answered the question, but I think for someone who's worried about volatility because they feel like they're not young enough to absorb the profile of stock returns, then bonds still play a role. And it's just figuring out how to size your bond allocation and then determining what your expected returns are. Maybe they're lower now than in the past. The other thing that I think that gets missed in this conversation a lot, and I don't know the specifics where the viewers are. In Canada, though, annuities are a pretty nice financial product that often get overlooked. Annuities are an insurance contract instead of an asset. It's not like a bond that you're buying. But an annuity guarantees to pay you out a fixed distribution for the period that you're still alive. Now, that last bit for the period that you're still alive, that becomes very important because there's something called mortality credits that you gain from annuities. Well, you can gain. If you live longer than expected, you win relative to people who lived shorter than expected. You gain credits from the people who died earlier than expected. Now, that sounds a bit morbid, but it's the way the products are structured, and it provides longevity insurance. So if you die young, you lose out on the annuity. Your estate loses out. But if you live longer than expected, you do very well. And in an environment where rates are low, those mortality credits, if you live past your life expectancy, those mortality credits can give you maybe even a comparable expected return to the yield that you're expecting on the bond. So I think in a low rate environment like we're in now, the argument for annuities because of the mortality credits is even stronger than in normal times. And there's always a good argument for annuities for retirees. So at 50, maybe not, but at age 65, 70, 75, you start considering annuities as part of your fixed income allocation.
Great. Yeah, that's good. I honestly don't know much about annuities in Europe either. So I think that'll be good to explore. Just a follow-up question on that. So, you still say bonds are still like probably the best like stabilizing part of your portfolio. And what is it fundamentally that bonds, are very good at that role? Like even if, currently the interest rates are so low and the yields are so low.
Bonds are safe assets because of their cash flow streams. They're called fixed income because you know what you're going to get. They've got predictable cash flows, which makes their prices relatively predictable unless we have crazy interest rate changes. And that predictability is what makes them valuable in a portfolio. From a consumption perspective, like when someone asks the question of I'm over the age of 50, how should I be thinking about my asset allocation? What they're really worried about is I'm going to have to fund my consumption sooner from my portfolio. And the cash flow, that the payoff profile from bonds is stable enough that I think it alleviates a lot of those concerns at the expense of expected returns. And that's the trade-off. I mean, this trade-off is going to be present in any financial asset that we talk about. If you take more risk, you have higher expected returns. And that often gets expressed as volatility in the market. If you take less risk, you have lower expected returns, and that's what you get with bonds. But if the objective is to reduce risk, then because of their underlying structure, bonds are really hard to beat from that perspective.
Great. Okay, so let's change topic a bit to education. So this question was asked by someone on Reddit called Temnovit. And he said that, Ben, you have 4 children. And how do you approach financial education with them?
Most of my kids are too young to be financially educated. I've got
What's your plan then?
Yeah, well, I do have one, a 6-year-old. He's my oldest, and so he's maybe old enough to talk about money a bit. But what we do, we talk very openly about money and about the household financial decisions that we're making. We explain the financial decisions that we're making for the household to the kids. I mean, if they'll listen, they don't always pay attention. My 2 oldest boys, they both have bank accounts in their own names that I make regular deposits into, like nothing, no huge amounts or anything, but they have money in their accounts, and we then make spending and saving decisions together because they know that they have money. They understand that they can trade money for stuff, and that creates a lot of good opportunities for conversations. Like, you could get this now, or you could save up and you could get something else later. One of the other things that we do is we have in my Rational Reminder podcast, one of the segments that we do is called Talking Sense, and we have these I have them on my desk because we do it for the podcast. These Talking Sense cards from the University of Chicago, from their financial education initiative, and they're really cool. I can pull one out so you can kind of get the idea, but they have just interesting questions. So this one that I just pulled out says, "What is your favorite way to help others?" So not necessarily directly about money, but they often back into financial concepts. So we'll pull those out every now and then and try and have a conversation about it. But again, with the 6-year-old being the oldest, the conversations they're not always that good. But yeah, that's what we do. So I guess to summarize that, we just try to have very open conversations about money.
Awesome. Cool. Thanks for sharing, Ben. So the next topic is climate change. And this was from a Reddit user, Tengo. Sorry about the Reddit usernames. I don't know how they come up with some of these. But their comment was that they worry a lot about climate change in general and the effect it's going to have on the global economy in particular. So they think that we're in the final stages of excessive consumption, and all of this will come to an end in the coming years as many governments are going to start to make big changes. These changes are good for our planet, but is actually bad for our investment portfolio.
It's a great question. And I have to thank the Reddit user, because I think I'm going to do a common sense investing video on this topic. Once I started thinking about the answer, I think there's a lot of really interesting stuff in there. Climate change is top of mind for sure right now for a lot of people, and I think that's the right thing. I think it should be on top of everybody's mind. From an investing perspective, I think that the question that we have to think about is the same question that we always have to think about whenever you see something new and think, is this different? Is this going to change investing? And the question we have to ask is whether or not climate-related risk is incorporated into asset prices. If climate risk is incorporated into asset prices, then that risk materializing should not have any kind of devastating effect on the payoffs for investors. If it's not reflected in asset prices, if it's this risk that's sort of a black swan that asset prices aren't reflecting, and the risk then materializes, then it could have a dramatic negative effect on asset prices. Now, financial markets are the best, and then this is not hyperbole, I believe this to be true. They're the best information processing machine that humans have created, that's ever been created. I mean, on our planet anyway. And it's so great at processing information because it aligns incentives. Like, everybody that's trading in the stock market is profit motivated, and because they're profit motivated, they're willing to dedicate significant resources to uncover new information that they may be able to bring to the market to gain an edge, to make a profit. Now, this has been studied, this question of whether or not climate risks are reflected in asset prices. There are two main types of climate risk. One is physical risk. Physical risk is like, you think about flooding, that kind of thing, like direct physical damage to property. And there's a 2020 paper, and these are all published in top journals, a 2020 paper called "An Inconvenient Cost: The Effects of Climate Change on Municipal Bonds." And this was an interesting one because municipalities can't move. Like, a company can pick up and move their headquarters if there's physical climate risk. A municipality, they can't. They can't get up and move because that's what they are. They're that geographic location. So this study, they found that higher exposure to sea level rise for municipalities is associated with higher municipal bond yields. So that's evidence of climate risk being incorporated into prices. They also looked at a different study, looked at the real estate market. This was a paper, "Disaster on the Horizon, the Price Effect of Sea Level Rise." And they found that houses exposed to sea level rise sell at a 7% discount relative to comparable properties that are not exposed to that risk. And the interesting thing about that finding was that most of that climate risk was expected to be about 50 years away. So properties that expect to be subject to flooding due to climate change within 50 years, we're selling at a 7% discount. So that's, again, evidence of climate risk being reflected, physical climate risk being reflected in asset prices. The other big one, and I think this is more the question that the Reddit user was getting at, is transitional risk. So transitional risk is uncertainty around how we're going to transition to a low carbon economy, and regulations, the scope and timing of regulations, which I think is what this question was was getting at. They produce a tremendous amount of uncertainty, especially for businesses that are relying on fossil fuels. So again, there's some pretty cool studies on this. 2015 paper, Science in the Stock Market, Investors' Recognition of Unburnable Carbon. They found for 63 largest US oil and gas companies, their prices fell by 1.5 to 2% after the publication of a paper in the journal Nature arguing that most fossil fuel reserves would need to remain untouched if warming is going to be kept under 2 degrees by 2050. So that was interesting because if what that paper said is true, the value of reserves would be zero. Now, that it wasn't true at the time, it's a possibility, but when that possibility became known, asset prices very quickly reflected it, which is kind of what you would expect. That's what markets do. They reflect new information. I also dug up studies that found that firms with negative environmental externalities have a higher cost of capital, and that one's not that surprising. Having a higher cost of capital makes it literally more expensive for those companies to invest and to grow. So from a business perspective, that's detrimental. It also has really interesting implications for ESG investing. I don't know if we want to go down that. I'll just mention for a second because it's so interesting. If you're an ESG investor, you're choosing not to invest in the bad companies and the companies that have these negative environmental externalities. By not investing in them, you're theoretically increasing their cost of capital. You're making it harder for them to get money. Now that can, kind of starve. You probably wouldn't actually starve them, but it can make it harder for those businesses to keep going. But as an investor, by nature of the mechanism that you're using to make the world a better place, you must expect lower returns, because if a company's cost of capital is lower, so the good companies, the green companies, you're making it easier for them to get capital. If their cost of capital is lower, you expect a lower return. Anyway, that was a total digression. I just think it's interesting. If you want to change the world by investing, you must expect theoretically lower returns from doing so. So there's the cost of capital. And in the options market, this is another really interesting study. In the options market, you can see a higher cost of insuring the downside risk of more carbon intensive firms. I thought that was fascinating too. So anyway, the idea here is that the market is and has been reflecting climate risk in asset prices. And if it is, which there's pretty strong evidence that it is, not that we don't need to worry about climate risk, but we don't need to worry about it being a black swan event because it's already incorporated into asset prices.
Good. I think there's some very interesting stuff there. So I guess, if things take long enough, then the market will already have incorporated that information. So to go a bit further, so fundamentally, when we invest in a globally diversified portfolio of index funds, we place a bet on the global economy to continue growing. But we live in a finite world with finite number of resources, and those are going to deplete one day. And so does that mean that fundamentally over the very long term, like investing doesn't make sense?
I don't know if that does make sense to say. I think if we made the assumption that capitalism must consume a finite set of resources, then the logical progression there would be that that investing eventually won't work. Not that it's going to happen now. I think there are a lot of cases like that we can make against capitalism as an ideology. The human experience, though, since capitalism has been the driving force, has shown us, well, depending on how you measure outcomes, I guess some people might say capitalism just destroyed humanity, but I don't know if I agree with that. From economic measures, humans are better off now than they've ever been, largely due to the outcomes of capitalism. There's a funny saying that capitalism is the worst economic system except for all the other ones, and I think that's kind of true. I don't think betting on capitalism means a bet on continued consumption and destruction of resources. And we're seeing a lot of this now, actually. It's kind of interesting to think about. There are non-market forces that can compel corporations to change the way that they're doing business and what they're consuming and what they're creating. And again, we're seeing this with the shift toward hedging against climate risk and ESG investing as a principle. Even if you don't expect a higher return from doing it, there is a chance that it does change the world. But what it also does, which is an interesting offshoot of ESG investing, or not even an offshoot, it's the intention, is it compels companies to act in a way that's more conducive to reducing their environmental impact, because their cost of capital should be lower if they do that, and that's no secret. Everybody knows that. So those are market forces, but there are also social forces, government forces, like we're starting to see potentially some regulation that's going to deal with the current level of destruction that's happening. And then the social discourse is, I guess, that plays into the market forces, but it's also seems to be pushing in the right direction. So I don't worry too much about like a total social and economic disaster from capitalism reaching the end of consumption, because ultimately the market and capitalism in general is this expression of human innovation. So it's not so much the question. That's maybe an interesting way to think about it. The question is less, is capitalism going to consume everything because resources are finite? Maybe the question we should be asking is, are humans going to stop innovating? And I think that the answer to that question is probably no.
Great, thanks, Ben. So the next question, it's another Reddit user. So this one is Muravej. And they say they respect you very much, so they hope you'll forgive them for the provocative question. So as far as I understood, you are a supporter of the efficient market hypothesis. If indeed markets are efficient, then why are there meme stocks? And if there are stocks that are crazily overpriced, does that mean there are also crazy undervalued ones?
So I don't think this question's provocative at all. I think the question just needs a little bit of clarification, or the ideas in the question, the premise of the question needs a bit of clarification. So I'm going to try and clear up what market efficiency means as it was intended. In 1970, Eugene Fama, he's the guy that kind of created this idea, or formalized it anyway. He defined the efficient market hypothesis with a simple statement, and here it is, that prices reflect all available information. That's it. That's all EMH, efficient market hypothesis, says. Now, EMH does not make any claim about what information should be in prices or how that information should be used. And we cannot say with certainty, and EMH was never designed to answer this question. We can't say with certainty whether asset prices are set by rational investors who are rationally assessing risk and expected returns, or if prices are set by irrational investors with unrealistic expectations or other motivations altogether, like going to the moon with a meme stock. But that's a reason somebody's investing. So that doesn't violate EMH in any way. And we always have to remember that the market consists of all kinds of different participants. There are individuals investing in their own accounts, which I mentioned earlier, are about a third of US investors. We've got mutual funds, we've got pension funds, we've got governments, we've got corporations. They're all participating in the market. Now, if you took a cross-section of those market participants and asked them why they're investing the way that they are, why do you own the stocks that you own, why is your portfolio set up the way that it is, they're all going to give you very different answers to why they're investing the way that they are. They've got different goals. They've got different views, different preferences. Their expectations for the assets that they own are different. So as I mentioned earlier, the stock market is this complex system that aggregates and processes information about the supply and demand for stocks. So we can say that the market isn't rational. Like, is GME rational? I don't know. Maybe somebody could argue that it is. I don't know if I would say that, though. But even if the market isn't rational, it is always in equilibrium. And what equilibrium means is that every trade has to clear. The price at the last trade, by definition, because the trade happened, there was a seller for the buyer. And like I mentioned earlier, it's also a zero-sum game. So there's a loser for every winner. So the information in prices doesn't tell us whether the market's efficient or not. It may tell us that it's irrational. I don't know. We also have to remember that this isn't the first time this has happened. This isn't the first time that a stock's price has gone a little crazy for reasons that don't seem like they're possibly based on risk and expected return. Volkswagen in 2008, there was a short squeeze situation. You could describe it maybe as a mechanical lack of liquidity in shares. And in 2008, Volkswagen was, because of this, was briefly the largest market cap company in the world. The price shot up so much. Now the price went back down when liquidity was restored, and maybe on the other side, maybe demand died down. There's another one in March 2000 where 3Com spun off Palm, and the price of Palm shot up to the point where it was more valuable than 3Com, which had just spun it off. Doesn't make a whole lot of sense. It was also more valuable than GM, Chevron, and McDonald's. Again, kind of crazy. It was a relatively small technology company. The price came back down. Now, again, we can't say with certainty whether that price jump was based on rational expectations or not, but it was absolutely based on supply and demand. We just don't exactly know what was driving those supply and demand forces. So I think if we ask the question, the original question of whether markets are rational always, no, I don't think that they are. There's no way to definitively prove whether markets are rational or irrational. But one of the really interesting things about that comment is that a lot of the pricing anomalies that exist, like I briefly mentioned value investing and factor investing earlier, those pricing anomalies are universally agreed on by academic researchers. They only differ in how they explain the anomalies. Is it explained by irrational behavior or rational expectations about risk and returns? And we don't know. So, to say that the GameStop situation violates efficient markets, it doesn't. It might mean that there's some different perspectives feeding information into the supply and demand of that stock, but that doesn't violate EMH. And again, interestingly, if we say what do we expect from GameStop as the example? Well, if you look at it from an academic perspective, how do you classify that stock? Well, it's a small cap growth stock with weak profitability. That's what it is. It's a small company. It's got a very high price, which makes it a growth stock, and it's got weak profitability. They actually behave like lottery tickets. I mentioned skewness in stock returns earlier. The most skewed subset of stocks is small cap growth stocks. So again, we get back into this idea of what's setting prices. It could literally be that people are playing the lottery. They see it as a lottery ticket, and that's why they're holding it. Skewness means on average, you're much more likely to get a bad outcome. But if you get a good outcome in small cap growth, they tend to be very good. So they're referred to in academic literature as lottery stocks. And then just to finish up on efficient markets, I think one of the really important points that often gets missed, I'm a proponent of efficient markets. Sure, I believe that's a good way to think about markets. But if anyone ever tells you the markets are perfectly efficient, you shouldn't listen to them because they're not. And market efficiency was always meant to be a model, not reality. If it was reality, it would be a fact, not a hypothesis. There's a great quote from Eugene Fama when he was having a conversation with Richard Thaler, who's one of the driving forces behind the irrational point of view on asset pricing. Fama says, the point is not that markets are efficient. They're not. It's just a model. And I think that's always important to keep. It's a really good model, and we should use it to gain insight. But it's just a model. So whenever someone says, well, this proves markets are efficient. Okay, sure. But that doesn't mean we shouldn't use it as a model anymore.
Hey, Ben, thank you so much. So we're kind of running out of time. So I'm going to pick one question from the audience, which should be relatively short to answer, which is PWL Capital in the EU, yes or no?
No. PWL Capital is a Canadian-based company, and we only take Canadian clients.
I think you got a lot of fans in Europe, so maybe you and Cameron should consider it. Your end, you got one more?
Yes, I do. So I think a lot of people here also learn, about investing through books. And so we were curious, what is your favorite book on investing? If you had to pick one.
Oh, geez. Probably my favorite book on investing is by Larry Swedroe, and I've got to remember the name. It's something along the lines of the only guide to factor investing you'll ever need, or something like that. But it's a comprehensive look at the academic literature on asset pricing and how investors can use that in their portfolios. So I think that's, as a starting point, like you mentioned, my white paper that I did on factor investing, Larry's book is effectively a much more comprehensive look at the same topic. But as a foundation for people thinking about investing in the stock market and trying to make decisions and figure out how to allocate their portfolio, I think having that fundamental academic understanding of how we believe markets work is one of the most important things that anybody can have. And that book does an excellent job of describing it.
Great, thanks, Ben. And yeah, the chat, there's so many people writing messages and discussing between themselves about factor investing as well. So it's great. So it really sparked a lot of conversations. But yeah, thanks so much for the interview, Ben. Thank you for everyone for attending, sending in their questions beforehand. We really hope you found it as interesting as we did. So in a few days, we'll email you a recording of the conversation, and we'll also transcribe it and publish it onto our website. So we hope you'll have a good rest of your evening. We're gonna shut down the live stream now. And yeah, thanks again, Ben, for attending and answering everyone's questions. Thank you.
Thanks for having me, and the questions were great.